Imagine inventing a medical treatment so, phenomenally popular that it literally alters the GDP of your home country.
Right, just completely shifts the national economy.
Exactly. Your factories are running around the clock. You dominate this revolutionary new sector of human health, and your brand name becomes an actual household verb.
Yeah, everyone knows the name.
But now, imagine that despite all of that, your stock is down roughly 27% year to date. It's caught in this brutal falling trend, and technical indicators are flashing slight sell signals.
Which just feels completely backward.
It really does. Yet some analysts are out there pounding the table, calling it wildly undervalued. So are we looking at a generational buying opportunity here, or the ultimate value trap?
I mean, it is the absolute definition of a battleground stock right now.
Welcome to the deep dive.
Yeah.
Today our mission is to cut through all that noise. We are breaking down the financials, the technicals, and the market psychology of Novo Nordisk, ticker symbol NVO, as of April 21st, 2026.
We got a lot of data to get through.
We really do. We're going to look at their full-year earnings, real-time order flow, and the latest news on competitive pricing pressures. Now, just a quick disclaimer before we get into the weeds. This is an educational deep dive into the source material. It is not financial advice.
Right, we're just analyzing the data, not telling you what to buy.
Exactly. And hey, if you're watching our video version, make sure to like the video, subscribe to our YouTube channel, and it's compulsory that you leave us your feedback in the comments. We want to know what you think of this setup.
We read all of them. So to set the stage and just ground us in reality, let's look at the real-time snapshot of where NVO is sitting right now.
Where are we at?
As we record this, it's hovering at $40.46. That's down a marginal 0.15% from the previous close. But, and this is interesting, it's showing some after-hours life at $41.02.
Okay, a little pulse there.
A little one, yeah. It's still in a long-term downtrend, but it's popped about 8% in the last 7 days.
Okay, let's unpack this. Because before we can even debate whether NVO is a trap or a treasure, we really have to look under the hood at the actual money they are making.
The raw numbers.
Right. So I'm looking at their full year 2025 results, and the income statement just feels contradictory to me.
How so?
Well, total revenue hit 309,064 million Danish krone, which is up 6.4% year over year.
Which is solid.
It is. But then I dropped down to the bottom line, and net profit was 102,434 million krone. That's only up 1.4%, with diluted EPS at 23.03 krone.
Yeah, that 1.4% profit increase sounds pretty weak for a pharmaceutical giant.
Right. Is this basically like buying a massive new house and then wondering why your checking account looks a little low this month?
That is exactly what it is. And what's fascinating here is what happens when you strip away those one-time shocks to their ledger. The house, in your scenario, is their massive $11.7 billion acquisition of Catalent.
Catalent, the contract manufacturer, right?
Precisely. Plus another 8 billion krone in restructuring costs on top of that. Without those massive expenses, their operating profit actually would have grown by 6%.
Oh, wow. Okay, so they basically bought out their own supply chain to fix the pen shortages.
Yeah, they had to. But that brings us to the balance sheet, because buying an $11.7 billion company leaves a mark.
I can imagine.
Total assets grew to 542,902 million krone, but their debt skyrocketed. It went from roughly 27,000 million in 2023 to nearly 131,000 million krone due to those acquisitions.
Wait, 131 billion krone in debt? That is a massive leverage bet.
It's huge. But, and this is a big but, their free cash flow made a massive recovery. It bounced back up to 28.3 billion krone, up from a negative 14.7 billion in 2024.
So the daily cash engine is basically printing money again.
Exactly. They even proposed a pretty healthy dividend of 11.70 krone per share, which is about a 50.7% payout ratio.
Okay, so if the cash flow has recovered from the acquisition and the top-line revenue is still growing, why is the stock price so utterly battered?
That is the million-dollar question.
Let's pivot from the company's internal ledger to the external market psychology, because the 52-week context here is just brutal.
Very brutal.
We're talking a 52-week high of $81.44, all the way down to a low of $35.12. I mean, who is actually trading this right now? Who is buying this dip?
Well, the order flow data is super clear on this. Retail traders are the ones buying the dip down in this $35 to $40 range.
Retail is buying it. What about the big institutions?
The large institutional funds are completely sitting on their hands. They are waiting for the May 6th earnings report. They won't touch it right now.
That is so telling.
And insiders aren't making major personal open market buys either. The only real internal focus is on the company's 15 billion krone share buyback program.
So retail is catching the falling knife while the smart money waits. Let's look at the technicals and signals to see if the charts explain why. Where are the actual support and resistance lines drawn?
So immediate support is sitting at $79.65. If it falls through that, there's a hard floor at $36.80.
Okay, and on the way up.
Resistance is at $43, with a major key pivot way up at $52.20.
Got it. And what about the moving averages?
Well, it's bullish in the very short term because the price is above the 5-day simple moving average thanks to that recent 8% pop.
Right.
But it is deeply bearish long term. It's trading well below the 200-day simple moving average, which is hovering way up around $50.
Okay, so a short-term bounce and a long-term downtrend?
Yep.
What are the momentum indicators saying? The RSI and MACD?
The RSI is currently 62.46, so it's bordering on overbought in the short term. But the up PD is at 0.24, which is actually flashing a slight sell signal.
Wait, hold on. Wait, if the RSI is creeping toward overbought, why is the MACD flashing a slight sell signal?
No.
Those feel like they're directly contradicting each other.
I know, it sounds weird, but there's nuance here. The stock just had a quick 8% burst, right? That pushes the RSI up really fast because it measures immediate speed.
Okay, makes sense.
But the MACD measures underlying momentum over time, and it shows that there just isn't enough actual force behind this move to sustain a true breakout.
So it's a hollow bounce.
Exactly. Sell-side volume has been incredibly heavy on all the drops. It did fade on the last trading day, which paused the immediate bleeding, but the big money isn't pushing it up.
With institutions waiting on the sidelines and the technicals showing this mixed hollow picture, it brings us to the ultimate question of this deep dive.
Let's hear it.
Is the stock actually undervalued right now, or is it a classic value trap designed to lure in retail investors? Let's check the analyst ratings first.
The consensus is a resounding hold. Over the last 3 months, we've seen 7 holds, 1 buy, and 0 sells.
And the price target?
The average target is $43, which is just a meager 6.1% upside from where it is now.
Wow, so Wall Street is not excited. But here's where it gets really interesting, because the bull case for it being undervalued is actually pretty strong on paper.
Oh, the valuation metrics look incredible.
Right, the PE ratio has compressed down to a historically low 11.16x. For a dominant pharma company, that is ridiculously cheap.
Bulls point to that constantly.
And they still hold a dominant 63% volume market share in the GLP-1 space. Plus, they're injecting a massive 75 billion krone in CAPEX in 2026 just to fix the Wegovy and Ozempic supply shortages.
They're spending heavily to keep their crown, yeah.
Oh, and we can't forget that wildcard strategic collaboration with OpenAI for discovering new treatments. So there's a lot to like.
There is, but we have to look at the value trap bear case, which explains exactly why the stock is getting hammered despite those numbers.
Let's hear the bear side.
The competitive moat is shrinking, and it's shrinking fast. Eli Lilly's Zepbound and Mounjaro are aggressively eating into their U.S. market share.
They are a massive threat.
And it's not just Eli Lilly. Cheaper, compounded GLP-1 drugs are flooding the market and creating immense pricing pressure. Novo Nordisk is losing its pricing monopoly.
Which brings us to the most devastating metric in our entire stack of sources, doesn't it?
It really is the smoking gun for the bears. NVO's own 2026 guidance predicts a 5% to 13% decline in total sales.
A decline, not a slowdown in growth.
An actual, absolute decline in revenue, specifically due to U.S. pricing reforms.
So it's like buying a ticket to a blockbuster movie half price, only to realize you're getting a discount because the theater's projector is broken.
That is a perfect way to put it.
You're getting it cheap, but the immediate growth story has basically stalled out.
Which naturally shifts us to what this means for someone's actual portfolio timeline. Let's talk about the downside risks and the horizon outlook.
Given this brutal headwind of a 5 to 13% expected sales decline, what is the risk here?
If we connect this to the bigger picture, you can see exactly why retail traders often get trapped in these setups. They fall victim to anchoring bias.
Anchoring to that old all-time high.
Exactly. They anchor to that $81.44 high from a year ago and just assume a return to those levels is inevitable.
Like gravity has to pull it back up.
Right, but they completely ignore the fundamental shift in U.S. pricing power and the intense volatility ahead.
So what are we looking at for the short-term outlook?
Short-term, expect sideways consolidation between $38 and $42 in the coming weeks. The entire market is just holding its breath for that Q1 2026 earnings report.
Okay, so a holding pattern. But what happens when earnings drop? What's the best case recovery scenario for the bulls?
The bull case is that management proves the supply expansion is paying off, and more importantly, the U.S. pricing hit lands on the lower end of that estimate, closer to 5%.
If they do that, what happens to the chart?
You'd likely see the stock break through resistance and attempt to reclaim that $52.20 pivot point.
And the worst case continuation for the bears.
It's ugly. Earnings confirm the bottom is not in, Eli Lilly accelerates its U.S. dominance, and the stock crashes right through that $36.80 floor, and below that, there's not much support.
Well, this really highlights the dual nature of Novo Nordisk right now. On one hand, you have a company with a historically low 11.16x PE, massive free cash flow, and 63% market share.
A literal juggernaut.
But on the other hand, it's actively colliding with a shrinking sales forecast, heavy debt from the Catalent deal, and fierce competition from Eli Lilly.
It's a tug of war. But I want to leave you with one final provocative thought about that wild card we mentioned earlier.
The OpenAI partnership.
Exactly. Right now, everyone, retail, institutions, analysts, they are entirely focused on the short-term price war and U.S. pricing reforms.
Because that's what's hitting the ledger today.
Right. But if that strategic AI collaboration with OpenAI actually simulates and discovers the next generation of metabolic treatments drugs that make Wegovy look obsolete, will this entire GLP-1 market share battle even matter in 5 years?
Oh, wow. That's a great point.
Or is this 2026 sales slump just the beginning of the end for their dominance? That's the real question you have to ask yourself.
That is a fascinating cliffhanger to end on. If they can use AI to leapfrog the entire industry, this whole slump might just be a blip. Keep questioning your sources, folks, and keep looking for the bigger picture.
Always look past the immediate noise.
Don't forget to like, subscribe, and leave your thoughts in the comments below. See you on the next deep dive.